What if you could put your money into 7 of the most powerful companies in the world with just one investment? Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. These companies have transformed smartphones, cloud computing, artificial intelligence, online shopping, social media, digital advertising, and electric vehicles. Together, they became known on Wall Street as the Magnificent Seven. But here's the interesting part. You don't necessarily need to buy all 7 stocks individually. There is an ETF designed specifically to give investors exposure to these 7 companies. It's called MAGS, the Roundhill Magnificent 7 ETF. And in today's video, we're going to break down exactly how this fund works, why investors are interested in it, what makes it different from the S&P 500 and NASDAQ, and most importantly, could concentrating your investment in just 7 companies be a smart long-term strategy or a dangerous one? Let's start with the companies. The Magnificent 7 are Apple, Microsoft, Alphabet, Google's parent company, Amazon, Meta Platforms, Nvidia, and Tesla. Each company dominates a different part of the modern economy. Apple dominates consumer technology and its massive ecosystem. Microsoft has become a powerhouse in software, cloud computing, and artificial intelligence. Amazon controls one of the world's largest e-commerce platforms while also operating Amazon Web Services. Alphabet dominates search and digital advertising while investing heavily in AI and cloud computing. Meta owns Facebook, Instagram, and WhatsApp and generates enormous advertising revenue. Nvidia has become one of the most important companies in the artificial intelligence infrastructure boom. And Tesla operates at the intersection of electric vehicles, batteries, energy, and autonomous driving technology. The reason investors call them magnificent isn't simply because they're famous. It's because these businesses have enormous scale, global reach, and major positions in some of the fastest-growing areas of the economy. But owning 7 individual stocks can be complicated. That's where MAGS enters the picture. The Roundhill Magnificent 7 ETF, ticker symbol MAGS, was created to provide investors with exposure to the Magnificent 7 through a single exchange-traded fund. Unlike a traditional diversified index containing hundreds or thousands of companies, MAGS focuses specifically on these 7 giants. The fund uses an equal weight approach. That means the basic idea isn't put most of the money into whichever company is largest. Instead, the fund seeks relatively balanced exposure across the 7 companies and rebalances periodically. That's important. Imagine you have $10,000. Instead of manually buying 7 stocks and constantly adjusting the portfolio yourself, an ETF can handle the portfolio structure for you. The exact weights can move between rebalancing periods as stock prices change, but the strategy is designed around equal exposure to the 7 companies. So instead of asking, which one of these 7 companies will win? An investor can essentially say, I want exposure to all 7. And that's the central appeal of MAGS. There is a simple reason investors find this strategy attractive. These 7 companies aren't just large. They are deeply connected to some of the biggest technological trends of our time. Artificial intelligence, cloud computing, digital advertising, e-commerce, semiconductors, consumer electronics, electric vehicles, and automation. Nvidia is supplying critical computing infrastructure for AI. Microsoft and Amazon are building enormous cloud platforms. Google is investing aggressively in AI and cloud technology. Meta is using AI to improve advertising and its social platforms. Apple continues to build its hardware and services ecosystem. And Tesla is betting on electric vehicles, energy, and autonomous technology. That creates a powerful investment story. If artificial intelligence and digital technology continue transforming the global economy, these companies could remain major beneficiaries. And that's one reason the Magnificent 7 have attracted so much attention from investors. In fact, the group has recently experienced significant swings. After a weak first quarter of 2026, the group rebounded sharply later in the year, showing both the potential upside and volatility of concentrating on these stocks. Here's where things get interesting. The biggest advantage of MAGS is also its biggest weakness: concentration. A normal broad market ETF might contain hundreds or even thousands of companies. MAG's focuses on only 7. That means if these 7 companies perform extremely well, MAGs can benefit dramatically. But if several of them struggle at the same time, the fund can fall quickly. Imagine a scenario where AI spending slows down. NVIDIA's growth expectations decline. Microsoft and Amazon reduce their capital expenditures. Tesla struggles with demand. Apple experiences slower growth. And advertising weakens at Meta and Alphabet. You don't have hundreds of unrelated companies to cushion the decline. You have 7 companies. That's the trade-off. You're not buying the entire American economy. You're making a concentrated bet on 7 of its most powerful corporations. So how does this compare with something like an S&P 500 ETF? The difference is diversification. An S&P 500 fund gives you exposure to hundreds of major U.S. companies across technology, healthcare, financials, industrials, consumer goods, energy, and other sectors. MAGs is much more concentrated. Think about it this way. The S&P 500 is like buying a huge city. MAGs is like buying 7 of the most important buildings in that city. If those buildings become more valuable, you can benefit enormously. But if something goes wrong with them, you feel the impact much more directly. That's why MAGs shouldn't automatically be viewed as a replacement for a diversified portfolio. For some investors, it could instead be viewed as a satellite position around a diversified core portfolio. Of course, whether that makes sense depends on someone's risk tolerance, time horizon, and overall financial situation. And then there's the biggest story of all, artificial intelligence. AI has become one of the central investment themes surrounding the Magnificent Seven. NVIDIA provides the chips and computing technology. Microsoft is investing heavily in AI through its cloud ecosystem. Amazon is building AI capabilities across AWS and its broader business. Google is developing its own AI models and infrastructure. Meta is investing heavily in AI for advertising, recommendations, and future products. Apple is integrating AI into its ecosystem. And Tesla is pursuing AI applications related to autonomous driving and robotics. But investors need to remember something important. A great technology does not automatically mean every stock will go up forever. The market ultimately cares about earnings, cash flow, competition, valuation, and future expectations. If investors pay too much for future growth, even an incredible company can become a disappointing investment. And that's one of the biggest questions surrounding the Magnificent Seven today. There are several risks investors should understand. First, valuation risk. If expectations become extremely optimistic, even strong companies can experience large corrections. Second, AI spending risk. The AI boom requires enormous investments in chips, data centers, electricity, and infrastructure. If companies eventually decide that the returns aren't high enough, spending could slow. Third, regulatory risk. Companies this large attract attention from governments and regulators around the world. Fourth, competition. None of these businesses operates in a vacuum. They compete against established companies and aggressive new competitors. And finally, there's concentration risk. 7 companies simply cannot provide the same diversification as hundreds of companies. Recent market moves have demonstrated this clearly. The Magnificent Seven can experience very strong rallies, but also sharp declines when investor expectations change. So, who might actually consider an ETF like MAGs? Potentially, investors who already understand the risks of concentrated equity exposure and specifically want exposure to these 7 companies. It may appeal to someone who believes that America's largest technology companies will continue to benefit from AI, cloud computing, digital advertising, and technological innovation. It can also simplify the process of owning the group. Instead of purchasing and managing 7 separate positions, one ETF provides a single vehicle for exposure. But there's an important distinction. MAGs isn't a magic shortcut to wealth. It's still an equity investment, and the value can fall. Sometimes significantly. That's why an investor shouldn't buy it simply because the companies are famous. The real question is whether the risk and concentration fit the investor's strategy. So, is the Magnificent Seven ETF a good investment? There isn't one answer for everyone. The bullish argument is powerful. 7 globally dominant companies. Massive technological advantages. Artificial intelligence. Cloud computing. Digital advertising. E-commerce. Semiconductors. And enormous global customer bases. But the bearish argument is just as important. High expectations. Concentration. Volatility. Competition. Regulation. And the possibility that future growth doesn't justify today's prices. That's what makes MAGs so interesting. It isn't a bet on every company in America. It's a concentrated bet on 7 companies that have already changed the world and are attempting to shape what comes next. And perhaps the biggest question isn't, will the Magnificent 7 survive? They probably will. The bigger question is, how much future growth is already priced into these companies? Because in investing, buying a great company isn't enough. Sometimes, the price you pay matters just as much as the company you buy. If you enjoyed this breakdown, subscribe for more simple explanations of the biggest investment trends shaping Wall Street. And remember, this video is for educational purposes only and is not financial advice. Always do your own research and consider your personal risk tolerance before investing.